branch to give his opening remarks.
Thank you, Jane. I welcome one and all to this seminar and good evening to everyone. First of all, I thanks to today's speaker, S.Aditya Kumar sir from Bangalore for accepting our request for giving the session on auditing standard, vice versa, common errors in financial statements. So I request all the participants to utilize this opportunity to enhance your knowledge and avoid the common errors in financial statements. You can utilize this session maximum. Thank you. Over to Jayant.
Thank you, Narayana, for your opening remarks. We'll start this program with our institute motto song. You need not stand, just place your right hand on the heart as a matter of respect. Because of the predefined settings, I am going with my mobile song. Please cooperate. Thank you. So before we start, let me introduce Aditya Kumar sir. So he is a BCom graduate from Bangalore University. He is also a fellow chartered accountant, diploma in information system audit or ICAI. He has certifications from ICAI, namely forensic accounting and fraud detection, business responsibility and sustainability reporting, public finance and government accounting, startups and MSME, intellectual property rights, and corporate social responsibility and impact assessment. And he also has certifications from ACCA UK, International Financial Reporting, International Standards of Auditing, Robotics and Finance. Coming to his accomplishments, he's a speaker in professional forums like Society of Auditors, CS Study Circles, branches of SIRC of ICAI, ICSI Regional Training Center of CAG of India, Fiscal Policy Institute of Government of Karnataka, Madras University, guest faculty at Christ University, Geetham, Reva University, and so on. He contributes literature on topics of auditing and assurance and financial reporting aspects in Internal Audit Today, published by Institute of Auditors of India, and Journals of Karnataka State CA Association on ESG related aspects. He also co-authored book on artificial intelligence in financial services and the risk story. Conversations on navigating the risk contributed to leveraging data analytics in internal audit. Conducted in-house training sessions and other knowledge sharing initiatives of the firm and other organizations. Participated in IASB and ICAI initiatives by contributing comments in amending the financial reporting standards. Sustainability reporting initiatives also taken by Aditya Kumar sir. Technical member of Financial Reporting Review Board of ICAI, special invitee on Central of Audit Quality Directorate, ICAI, and other technical groups. Coming to his professional expertise, advising clients on Ind AS, IFRS, multiple gap to Ind AS, including transition and implementation, training and regular updates and implications. Statutory audits, limited review, internal audit, and so on. There are so many audits handled by Aditya sir, including Fortune 500 companies, Navaratna companies, and Maharatna companies, and PSUs, and so on. And he also due diligence on behalf of Office of Official Liquidator and for other acquisition transactions. He's also experienced in special assignments relating to review of the consolidation procedure and benchmarking accounting practices investigation into fraud activities and due diligence reviews and so on. He also involved in SOX compliance testing of an MNC, involved in manufacturing of consumer electronic having global operations including presence in China, Taiwan, Europe and US, advising clients on ESG reporting aspects, experience of working overseas including China, Taiwan and Saudi Arabia. So with this brief introduction, sir, the floor is to you. Thank you once again for accepting our invite and sharing your knowledge in this right time, sir. Please go on, sir.
Good evening to all, and thank you, I.C.A. Vijayawada, for hosting this webinar. I hope I am audible, and my screen continues to be visible to all of you.
Audio is good and also visible.
Right, great, sir. So let's keep this session as much interactive as possible, because the more we discuss, the more we learn from each other's experience. This particular session, we are trying to look at some of the financial statements historically presented and to see what are the common errors that has been identified. And before we get into that, we should also understand that today we are living in a scenario where you may agree that profession as such is under great scrutiny from the regulators. The expectation of the shareholders, stakeholders rather, is completely different and it's actually heightened. Most importantly is the rigor in which the financial statements are being prepared and presented has also changed in two ways. One, we are looking at more and more compliance and reporting requirements. Second, the timelines to have these financial statements is going to only get reduced. Third, the audit speed and the audit quality is also expected to increase. Having said that, we have the benefit of a lot of literature available from the ICAI and its group, whether it is the Financial Reporting Review Board, whether it's the Quality Review Board, NEFRA findings, and so many other guidances that ICAI has, based on which we need to keep updating ourselves on the nuances in the financial statements and the way the audit report needs to be drafted. So if you look at the outline of the today's program, largely I have drawn out the observations that we as professionals either experience over a period of time. Then we have the literature from ICAI. Some of that are available on the ICAI website, the FRRB website or the QRB website, which should be used for our learning. Second most important thing that I would like to draw everybody's attention here is the day of thinking that the financial statements of only the larger companies or the corporates are under scrutiny is over. I mean, all the financial statements today are under scrutiny. And it is our responsibility, whether we sit on the side of the management wherein we have to prepare the financial statements with utmost due care, or we are sitting on the other side of the table as auditor to give any opinion on this. Even for non-corporate entities, we have now guidance note issued by ICAI on how the financial statements of non-corporate entities is also to be brought up. So if you look at the guidance note given by ICAI on that aspect, it's more or less equivalent to what they're expecting any other corporate entity to bring in. So suffice to say that the rigor in which the financial statements are expected, the quality of the financial statements that are expected to be presented is only increasing. Second most important thing is the review mechanism has been strengthened a lot. The days of reading the annual report and observing the issues, then reporting it to the auditor or to the company has only speeded up by using technology, wherein you have to upload the financial statements and you have a standard format in which it has to be prepared. The system picks up what are the anomalies and notifies it. So that is the speed at which we are working. And if you look at the developments from ICI, we have AI of ICI, which is again available for free with on the website. A lot of queries that we have, whether it is relating to accounting treatment or how a particular issue was dealt with by an expert opinion or has it been dealt by an FRRB, is all available on ChatGPT of ICA. So those are all the new developments that are happening. So for our session, we are looking at certain common errors that we find in the financial statements, and we go with the major components in financial statements. And in the we have 2 hours time, so I will try to see how much we can cover it in 2 hours. And I'm always available if somebody needs any information or they can contact. When we look at the balance sheet and the profit and loss, couple of things that has changed from last 2-3 years, especially for corporate entities. We had the major amendments in Schedule 3. But we still see that many of the corporate entities still prepare the financial statement in absolute terms. That is, the full amount is being written in the financial statement. The rounding of these financial numbers is becoming mandatory after the amendment. You cannot have a balance sheet or statement of profit and loss with full amount. So in Schedule 3, both Division 1 and Division 2 and in Division 3 as well, they have given slabs as to what are the minimum revenue requirements to round off the figures to the nearest lakhs or thousands, and what should be the what should be the rounding off if it is more than if you have to round it off in crores and beyond that as well. This is also something very important because it can be construed that the financial statement is not as per Schedule 3. That is one big change that has happened. The second thing is, many times we see that the name of the company would have undergone a change, but we forget writing that in brackets underneath the name or next to it. Any change in the name of the company should also be mentioned for next 1 or 2 years so that the reader will have a track of this was the name of the company. In the financial statements, we also observe that the company identification number is not being mentioned. So we have to ensure that company identification number or CIN is also mentioned. Fourth important aspect is operating cycle is not defined. Now, this amendment came through Schedule 6 and later it came into Schedule 3 as well. Many companies don't mention what is their operating cycle. It's important to define for the company what is an operating cycle. Is it not defined in Schedule 3? Yes, it is defined in Schedule 3. But Schedule 3 definition need not be the case in a particular company. They may have an operating cycle which could last more than 1 year also. So depending on the nature of business, we will have to classify or we will have to define operating cycle and then later classify current assets and non-current assets, current liabilities and non-current liabilities accordingly. When it comes to classification, one more area that we have found is deferred tax asset or liability being classified as current, which is not the right position. The correct is it should always be shown as non-current. So these are some of the common errors, low-hanging fruits that I would call that can be corrected. Similarly, reconciliation of shares, classification of loans payable in next 12 months. Some companies continue to classify it as other current liabilities instead of short-term borrowings. All this also has to be taken care of. Now, the major areas that we find errors are, for example, in cash flow statement. And from here on, what I've done is on the right-hand side of your screen, you would see a shaded area that is the reference to an auditing standard or reference to what are the documentation requirements, and commonly what we find that these documents are not available. Cash flow statement is one area where I find it is sort of a neglected area because people tend to believe that once the formulas are linked, it should be taken care of. there are many nuances to it. In fact, we can have a 2-hour session only on cash flow statement. It is that complex actually. So when we look at the classification of cash and cash equivalents, Schedule 3 talks about cash and cash equivalents from the date of balance sheet. Whereas, if you read the standard on cash flow statement or statement of cash flows, the period to classify something as cash and cash equivalents is from the date of investment in that security. So there are two different starting points. What is as per Schedule 3 should also be complied with, and what is required under Ind AS or AS3 should also be complied with. That is where the guidance note comes to the rescue, and it talks about how do we harmonize these two. So any security, cash balance, term deposits, which is expected to realize in next 3 months, right, without much of a loss, we still can consider that as a cash and cash equivalent. Now, where do we find errors in it? Suppose a company has liquid mutual funds, or there are securities which gets realized in next 3 months. It is technically a cash and cash equivalent for the purposes of cash flow statement. But for the purposes of Schedule 3, it will continue to be as an investment. So what happens? Your cash and cash balance, what you see in the balance sheet and what you see in the cash flow statement, the general understanding is these two should match. We are of the opinion that it need not match, because what you see in the balance sheet is as per Schedule 3 requirements. What you see in the cash flow statement is what is as per AS3. So you will have to ensure that these two are, wherever there are differences, those differences have to be reconciled in a statement and has to be produced. This is the first observation I have. The second observation that we see is certain bank balances like unpaid dividend or margin money or security against borrowings for some reason gets classified or included in cash and cash equivalents. That should be excluded because that is not available for use in the general purpose. Either you will have to exclude it or you will have to give a note saying that the above cash and cash equivalents includes these two balances or any other committed accounts, and therefore that cannot be construed as cash and cash equivalents for the purposes of AS3. So normally any bank balance, we consider it as three parts. Anything that gets realized in equal or less than 3 months, we take it as cash and cash equivalents. 3 to 12 months, we take it as other bank balances. And anything which is maturing beyond 12 months, we take it as non-current assets. So that's some of the errors that we have found in the financial statements. From the documentation perspective, if you look at it, very important aspect is the auditor should have the control over the confirmation process. The client should not be sending the confirmation. We will have to send the confirmation. Our auditors have to send the confirmation. That confirmation of balance should be directly received by the auditor. If it's a postal letter, it should be directly coming to their office. We need to document even the envelope or the letter that has been received as a proof that this document has come through this particular, postal service. And you may argue that there are softwares or applications like confirmation.com or any other third-party application. The institute had come out with a notification that any third-party or intermediary application or software or portals should not be used for the purposes of obtaining confirmation of balance from the bank or from any other agency. So that is also something that we need to remember. So sum and substances, we need to have an absolute control over the confirmation process. Second is lack of documentation or evidence of reperforming the bank reconciliation statement. So it's just not enough now to have a bank reconciliation statement in the file. What is the evidence that the auditor has that the bank reconciliation statement has been done on a has been reperformed and test checked. And in case of bank reconciliation statement is prepared by the client, it has to be signed off adequately, because again there is a maker and checker concept. Without signing off, we will not even know whether the reconciliation statement has been prepared by the client and who has prepared it. So these are some of the questions that we have raised, or somebody would have asked us through FRRB or through peer review process as to what should be done. Another important area where we find lack of documentation is the interest income, or the bank interest income has not been reconciled with the 26A statement. So how do you know whether the interest has been accounted completely or not? Similarly, any statement that you have issued to the bank as part of your inventory or receivables taken on security, there's a difference in the inventory valuation and the receivable status between the document given to the bank and the books of accounts, which also needs to be reconciled and documented. Audit also has to include how will they document the evidence of whether all the borrowing conditions are met in case they have taken loans, and if at all there are differences between confirmation of balance and bank statement, that also needs to be documented. Now, why is there so much of interest on audit documentation? Is because of the changes we are seeing in the regulation, and even the standards of auditing or documentation clearly mentions that when somebody looks at the file who has not been associated with the audit, they should be able to, convincingly, or they should be convinced that the audit has been done as per the standards of auditing without any major interference from the audit team. So that we are at the days where if it is documented, it is done. If it is not documented, that area has not been done or audit has not been carried out. That is the conclusion that one can draw in these days. So that is on the cash flow statement and statement of cash flows. The other area that we could look at is on the investments part. The common errors that we find is either there is absence of accounting policy on investments and on dividend accounting, and especially those companies which have investment in partnership firms, we have found they don't disclose the share of capital or profit or loss that has accrued, the names of the partner and the share of the profit. They don't mention all this at all. These are all the requirements under Schedule 3. Similarly, any profit or loss that a firm or LLP gets accrued should also get accounted. When I discuss some of the fundamental issues, like why consolidated financial statements of the company is not prepared where they have control over a firm and AOP, the wrong notion is you don't have to prepare consolidated financial statements because of it, you have invested in a firm or an LLP or an AOP like that. No, there is nothing like that. In fact, the institute has clarified that where those investments qualify to be called as a subsidiary, you still have to consolidate the company's accounts and with the LLP, and you will have to prepare the consolidated financial statement. I do acknowledge and agree and appreciate that it is quite possible that the non-corporate entities could be following cash system of accounting. Their books of accounts may not be as rigorous as that of the company. Nevertheless, the institute guidance is very clear that once you invest in any of these non-corporate entities and under accounting standard 21 or under Ind AS 110, if you classify that as a subsidiary, then consolidated financial statements has to be prepared, and that has to be presented, or the normal process of what you do for standalone financial statements needs to be given, including approval by the board and AGM, everything. The other area of common errors that you will also find is a company would have invested or would have got a, say, immovable property, a building, for example, on which it is getting rent. technically that should be classified as investment properties. That is what is given in Accounting Standard 13, even under the accounting standards. Of course, Ind AS has a separate standard for investment properties, wherein you require to disclose the fair value and the expenses incurred on that investment property, etc. But at least under AS, you have to only classify those investments as investment properties. Disclosures relating to whether those investments are quoted, unquoted, where did you get the market price from, these are all not disclosed in the annual reports or the financial statements. That also needs to be taken care of. So these are some of the errors that we see in investments in partnership form. The other area where you will find a lot of errors is the classification. Now, just like there is a difference in cash and cash equivalents in Schedule 3 versus AS3, Schedule 3, Division 1, Division 2, this is AS3 and Ind AS 7. Similarly, under AS 13, we talk about long-term and current investments, whereas Division 1 and Division 2 talks about current and non-current classification. It is just not the nomenclature that has changed. Again, under Schedule 3, the classification starts from the balance sheet date, whereas under accounting standard, it starts from the day of investment, whether you classify something as long-term or current. Now, because there is a classification issue, it is quite possible that what you classified as a long-term investment could be classified as current because it is expected to realize within 12 months, in which the entire matrix of the investments will undergo a change. Definitely, it is possible for a long-term investment to be classified as current because at the point when that investment was made, it was for long-term. But as time passes, it could be realized in next, say, 2 months or 3 months, within 12 months. Therefore, it is classified as current. So, it's essential to understand that long-term is not non-current. And similarly, as I said in cash flow statement, you should see what is the starting point of classification. Then, where there are investments, for various reasons, the loss in the value of investments is not being recognized. That is not correct. Just like how you are expected to test the impairment of assets under AS 28 or Ind AS 36, here also investments have to be tested for impairment, and wherever there is a loss, that loss needs to be accounted for. From the audit documentation perspective, if you look at it, we may not have, we would have seen that companies may not have board resolution for investments, or the auditors have not kept a copy of the board resolution, compliance with Section 186 or any other provisions of the Companies Act. Typically, 186, when you give money to another corporate, you also have to disclose certain things in the financial statements. That has not been disclosed. Valuation report, wherever you have invested in another company based on some valuation, that is not there. And even if the valuation report is there, how has the auditor reviewed that valuation report? How has he challenged the input data that is being used by the valuer? Is it in compliance with the valuation standards? So these aspects are not documented many times, and that will draw attention of the reviewers. Last but not the least is on the basis of valuation. On what basis you find that this investment is worth the carrying amount in the balance sheet. So these are some of the areas where we need to be a bit careful when it comes to investments. I'll just open the chat box just to see whether there is any other query so far. There is no query so far, so we'll continue with the session. Another big area that we always have is the inventory as certified by the management, as relied upon by the auditor, should not be used in the financial statements. Why? Because financial statements by itself is the responsibility of the management. Inventory is just one component in that. Therefore, writing that inventory is certified by the management is incorrect. Second is as relied upon by the auditor. The company should not be writing what the auditor has relied upon or what they have not relied upon. If the auditor is satisfied with the inventory valuation, with respect to that, the report will be dealt with. But if the auditor is not satisfied, then whether the report has to be modified or what should be the appropriate mention in the audit report is taken care of by the auditor. So, as relied upon by the auditor, as certified by the management, should not be given in the financial statements. Second is AS2 talks about fair net realizable value, but we see terms being used as market value, estimated value, fair value instead of net realizable value. You will not be able to use any other nomenclature other than what is given in the accounting standard. Then, difference between inventory as per books and as per the information furnished to banks and financial institutions. The reason why there could be difference is because the company may not have the robust system of inventory valuation which should have been done at monthly level or quarterly level, and therefore they take whatever is the value as per books and give it. But if you actually do the inventory valuation for that particular month or that particular quarter, you will find that there are differences between what is furnished to the bank vis-a-vis what is actually available with the company. Schedule 3 requires to answer this as to why there is a difference, and the auditors will also have to ensure that it is adequately reported in CARO as well. Certain retail companies are entitled to use this retail method of inventory valuation, where they typically get the sale value of all the inventories that they have, and they reduce the margin, and they arrive at the estimated cost. We see that the classification of that inventory, sub-inventory, is incorrect, or there is an arbitrary method of calculating the margin to arrive at the cost and to fine-tune with the gross profit or the net profit. This becomes a big risk to the auditors. So they will also have to have documentation as to how they satisfied themselves that this is the profit margin that the company is reducing from the sale value. Similarly, those companies which use standard costing as one of the mechanisms, what is the basis of standard costing? How frequently is it being revisited? How is the variances between standard cost and actual cost getting accounted? These are some of the areas where auditors have to be careful, because that also should get documented. Otherwise, you will end up saying that you have valued inventory, but you do not have the basis of concluding as to how that inventory has been valued. When it comes to method of valuation, the terminology is typically used as simple average, but the standard talks about only weighted average. It's not simple average. Then incorrect classification of PP and inventory. This we have typically seen in manufacturing companies and other companies where they have a lot of spare tools and etc., which is expected to be used beyond 1 year. In that case, it has to be treated as property, plant and equipment and not as inventory. That again becomes an issue when you do the classification between current assets and current liabilities, and instead of depreciating it over a period of time, you write it off in 1 year, and that impacts the profitability. Coming to inventory valuation, overhead absorption calculations largely done, but then at what capacity it is being done, how did you ensure that the capacity that is being used, the normal capacity, is correct, also needs to be documented. Many times we don't see goods in transit not getting disclosed. So as of 31st of March, if it's the period end or year end, you also have to ensure goods in transit also gets accounted in the books if it is required, and if there is a valid case for you to record that. So when you are recording goods in transit, you will have to also ensure that the categories also is required, like raw materials, finishing goods, stores and spares, Any of other categories that the company is using should also be disclosed. Coming from the audit documentation perspective, what we see normally is we have something called as SA 501, which talks about how do we get audit evidences for inventory valuation. Many times there's a perception that, okay, I have the inventory verification sheet that holds good for the documentation. No, you will have to start from the point where the management gives instructions to the staff on how to do the physical verification, what is the methodology, who is going to verify, who will be also overseeing the whole exercise. Then the auditors presents their checklist that are available. All that also has to be documented. Ensure that the representative of the client is also signing the physical verification sheets. Maker checker is also equally applicable for inventory verification. Do we have the expertise in certain categories? See, generally, if you have spent so much of time with the client, understanding their business, you should be able to understand what type of inventory it is, how is it being classified, etc. But if you find two things, that if it is highly complex, highly technical, then you have to look at whether you may have to hire an auditor's expert to help you in understanding whether that is what is the inventory. Can you rely upon the expert of the client? You can, but you will also have to ensure you do the proper due diligence before relying upon the expert of the client. Similarly, CARO also requires to report a variance of 10% in physical verification. Now, you may have done the physical verification, but what is the conclusion? How do you ensure that the variance is not beyond 10%? This also needs to be documented. Last but not the least, the difference between a physical stock and book stock, that is the information given to bank, reportable by auditors, is for 5 crores and above. But when you look at Schedule 3, there is no monetary limit of 5 crores and more. That's my understanding. But in CARO, there's a requirement only if it is above 5 crores, you will have to report. Some of the companies which also have, what do you call it, job work related transactions, and where you would have given certain assets or tools to the job worker, you'll also have to ensure that the physical verification takes place even for that. And if the auditor is able to go there and verify, nothing like that. But for any reason the auditor is unable to go there, then they will have to request a confirmation of existence of those tools or items or inventory from that particular location, just like how we do for bank balance or receivables and payables. So confirmation of balance would also be required to be documented. So inventory is another area that needs to be taken care of very, very carefully. Some of the areas where typically the regulators or the government or stakeholders are very, very sensitive are revenue, inventory, receivables, loans, where even the smallest of the error they will be uncomfortable with. So this is our experience, and we'll have to be extremely careful in valuation of all these transactions. I'll just pause here for a moment. Is there any other question at this stage? Would be happy to address that. Right. We'll move on to another related topic, that is property, plant and equipment. We continue to use the word fixed assets because that's what we have been very familiar with from years. But on paper, it should always be property, plant and equipment and not fixed assets. Similarly, in CARO also, you will have to mention it as PPE register and not fixed assets register. Depreciation calculation, whether it is AS 16 or Ind AS 16, it is from the date available for use. But for income tax purposes, it's always the date which is put to use. This is my understanding of tax. I'm sure in the learned audience there will be many tax experts who would agree with me. If I'm off the mark, they can correct me. So there is always this difference in the dates, and we have to ensure that the depreciation that gets calculated is from the right date. We normally come across these issues when the assets are received, but it gets delayed in accounting. The invoices are received much later. So there is always this confusion of what date needs to be considered. Other accounting standard says from the date it is available for use. So as long as you can identify that date in the various records of the company, that should be the date from which the depreciation needs to be calculated. Arithmetical errors in depreciation is very common, especially when we rely upon Excel sheet to ensure that the formula is consistent across the cells. It can be a case where certain times you may have to tweak the formula to accommodate a particular line item, and we just miss it in the next financial year or the next year, and the error continues. So it is better to reevaluate whether the formulas that are being used is correct. Those companies where the fixed asset register is in SAP or any other application, we typically look at the master configuration of the depreciation. We look at the controls surrounding on updation of the master, and we reperform the depreciation on a test check basis. So take about 10-20 line items from different classification of assets, recompute the depreciation, compare the result of the depreciation with what the system is giving. Only then you can be assured that, okay, the system does the calculation appropriately. Second, we can also use a certain amount of technical analysis or statistical tools to see what has been the depreciation or quarter on quarter or month on month, and see why there are variances. Now, when it comes to depreciation calculation, we have also seen certain clients saying that 20th is the cutoff date. Anything that we capitalize before 20th, we take it as depreciation. Anything that we capitalize after 20th, we take it in next month's depreciation. Or they may say that I will start calculating the depreciation from first of the month, irrespective of when it is actually capitalized during the month. These are some of the practices that many companies follow, because on the argument that that is what the group follows, or that is what the parent company follows. As far as our scope of work in statutory audit, it is only to mention whether the financial statements show true and fair view as per the accounting standards, and which also includes Schedule 3 requirements to be met. If that is not met, you will have to take a call to see whether your report is going to be modified or not modified. Depends on the materiality of that particular error, etc. But even if it is so, you will have to advise the management that you may have any calculation for the group, but for compliance with Schedule 3 and compliance with the India standards, this is how the calculation needs to be done. If you look at the impairment testing, another standard which is neglected, Accounting Standard 28 Para 6 requires to assess the indication of any impairment at an annual basis. So on an annual basis, they will have to relook at their business, relook at their cash flows, relook at whether the assets carrying value is worth what is there in the balance sheet. If required, then you have to also provide for the impairment class. That is very important. Many companies don't even test it for impairment, saying that anyway my business is running in profits, why should we test it for impairment? last so many years we have never had any loss, or we are having so much of orders which will ensure that we get profits, therefore impairment testing is not required. The argument may hold good in certain situations, but then to substantiate your stand as to why impairment loss need not be reckoned with because there is some value left out in that asset, you will have to document it. Unless you document it, you will not be able to, prove that the impairment testing was actually carried out. Then the other type of errors that we see are the minor ones, like the incorrect classification of property, plant and equipment. What should be there in furniture goes to office equipments or goes to plant and machinery or is included in leasehold improvements, etc. Capitalization process. This is also very important. Nobody tests, whether as part of ITGC testing or ITAC testing, we will also have to look at how the formulas are being used. How does the management review the capitalization process? We have seen assets lying in capital work in progress and not being accounted for at the right time. It normally comes up during the audit process. When you look at the aging analysis of capital work in progress, you realize that there are so many assets which were supposed to have been capitalized but not capitalized. So those are some of the errors that we typically see in property, plant and equipment. And likewise, what is said for inventory, wherein you need to have instructions by the management on how to do physical verification report, maker checker concept, maybe auditors expert if it is required. All this also have to be taken care of before we conclude that the physical verification is adequate. Similarly, for the samples that we would have selected, copy of invoices, purchase orders, asset receipt notes, proof of capitalization, installation certificates, all these are also required to be documented to ensure that there is enough evidence that the auditor has gone through all this. When it comes to immovable properties, especially absence of copy of the title deeds, sometimes these title deeds would have been kept in the bank, more like in a locker, or it would have been given as a security against a loan. Whichever way it is, if it is not possible for a company to bring all the securities, immovable property, title deeds to the office and auditor to review it, we can send out a confirmation to the bank saying that these are the list of title deeds that are available with the bank. That's what our client says, kindly confirm. So that document at least should be there to have some satisfaction that the title deeds of land are deposited or is in the custody of the banks for either a loan or it has been kept more as a safe custody. So these are some of the points that we will have to keep in mind when dealing with property, plant and equipment. Another sensitive area is revenue recognition. Now, let me be honest in telling this. GST requirements, ICDS requirements, AS9 requirements, or Ind AS 115 requirements could be completely different. If they are different and they have to be reconciled and recorded. GST, ICDS or any other commercial tax or any other regulations cannot dictate when I should recognize revenue. For us, revenue recognition should be as per Accounting Standard 9 or Ind AS 115 as the case may be. If there is a difference, that difference has to be reconciled and it should be documented. It has to be explained. It could sound to be a little bit harsh, but that is what it is. Many times we have seen clients arguing that I've raised invoice, so I will recognize revenue. Raising an invoice is required as per the tax laws. Raising an invoice has nothing to do with AS9 or Ind AS 115 because those standards never deal with when you have to raise invoice. They only deal with when should the revenue be recognized. So these are two different things. So revenue to be recognized under Race 9 is largely based on when the risk and rewards gets transferred, and under 115 only when the specific obligations are fulfilled. I may have raised an invoice, but if the risk and rewards are not transferred or the obligations are not met, I cannot be recognizing revenue. Similarly, when the accounting policy is drafted, they typically mention that revenue is recognized at the point of sale. It doesn't convey any meaning as to when the risk and rewards gets transferred. So if it is a simple transaction where the goods are sold and it is ex-factory, we typically have to mention that revenue is recognized at the point when the goods are delivered to the customer or handed over to the customer, which coincides with the transfer of risk and rewards at that particular point of time. So in the accounting policy, you'll have to be very clear as to when does that risk and reward gets transferred in case of sale, when does it get transferred in case of a service, and if you have a long-term contract, how are we recognizing revenue, whether it is on percentage completion method or proportionate service method or completed service method, what exactly is the methodology used? The terms of sale should also be considered. Is it FOB? Is it ex-factory? All this also have to be considered when we are drafting the accounting policy. Another area where professionals find difficult is when we find that the revenue as per books of accounts or the accounting package and the billing software could be different for various reasons. So then how does the auditor get the comfort that the billing software is complete and accurate also needs to be? Sir, can it be muted? We are hearing some background noise. Right. Thank you, sir. Thank you. Then incorrect exchange rates used for exports. This is something which even ICA has brought out. Companies which normally have exports, they take the customs rate for the purposes of accounting revenue. But under AS 11, it says you have to use the spot rate. The spot rate is not what the customs use. Customs department uses a different rate. They typically use a weekly average or something like that, which gets published. You'll have to use the spot rate. Then, when there is an export, you may have unhedged foreign currency exposure. That also needs to be disclosed by the in the financial statements. The areas where the documentation seems to be lacking is where the cutoff procedures are not carried out. Cutoff procedures are required to ensure that the revenue of a particular period doesn't get spilled over to the next accounting period, or whichever is the next subsequent period's revenue doesn't get accounted in the previous period. So the cutoff procedures also needs to be followed and documented. And any item that you take in the P&L, typically purchases, sales, expenses, what is the sample that you have selected and what is the methodology to select that sample also needs to be documented. And when we take samples, it's not that, we just take, say, I have 100 transactions, I will take 10% or 20%. Now, when we are facing the reviews from various regulators, they are now asking why it should be 20%, why it should not be 25%, why it should not be 30%. So the sample selection typically is a process which you will have to look at from the risk perspective of that particular client, from the number of transactions, volume of transactions, amount involved, extent of technology involved in it, manual versus computer or manual versus automated processes. So you will have to take a holistic view of all this and then decide what should be the sample. Now we are actually looking at a scenario where, in fact, in one of the conferences of ICI I was attending, they are saying, why should we even do a sample check going forward when we have AI tools and we have machine learning? You can do 100% check. We don't have to do sample check, but then that's another argument. Fraud risk is one of the major areas in revenue recognition where you will look at overstatement of revenue, or it could be the other way around where revenue is understated as well, especially when there are cash transactions. The moment there is a cash transaction, the antennas go up and it sounds that we will have to be a little bit more careful. Fraud risk assessment is for true, and again under SA 240 you need to assess and document under risk assessment how the fraud could be perpetrated in this particular what do you call a company or particular set of transactions, and what is that the auditor has done in their risk assessment procedures to cover these risks. I agree that the objective of audit is to give true and fair view and not give a guarantee that there is no fraud. But the expectation of shareholders today are changing. That's where I leave it. But wherever you have done fraud risk assessment, you need to evaluate every year, every accounting period to see what could be the possible frauds that could happen, especially in areas like revenue, which is highly sensitive, and what audit procedures have you designed to ensure that such risks are mitigated, and what is the documentation that we have. Beyond invoices, you would also have to look at agreements, system configurations, especially in retail. How are the systems configured? How are the rates configured? What is the maker-checker concept? Is it possible to penetrate the configuration and tamper with the rates? That is the reason this also has to be linked to the reporting of audit trail and other things. As to is it possible to get into the system, tamper it, and then alter it, but there is no audit trail left. You will always have to look at fraud not only from the traditional fraud point of view, but also from the technology part also, to see what can be covered in the audit. Revenue is a highly sensitive area. I have a question on the chat box which mentions, are we entitled to rely on the chartered engineer's report on the useful life of assets where the engineer is hired by the client? So we will look at it similar to SA 500, like how the client hires an actuary and how we rely upon the actuarial valuation report. I have covered actuarial valuation report in the subsequent slide, but I will take it up because you have raised this question. Now, normally what happens if a chartered engineer has been appointed by the client to estimate what is the useful life? First of all, we need to assess the competency of that chartered engineer. Wherever they are appointing an actuary, chartered engineer, valuer, any other person whose report gets used in the financial statements in any manner, how do we know that he's a chartered engineer? What is the basic due diligence that we do? Did we get the engagement letter? Do we know that they are entitled to practice as a chartered engineer, just like how we have membership number or affiliation with a particular institute? I'm sure they must be having such licenses to operate. So, do we know that they are having it? One. What is the input data that the valuer or the chartered engineer is using? Is it possible for the auditor to actually understand or try understanding what is the input data? We may not be able to draw conclusions like a chartered engineer. Say, for example, they are giving these assets for the purpose of calculating the useful life. The basic things that we will have to document is, are those assets in my FA register? How old are these assets? If you have the benefit of the annual report of companies within the same industry or peer group, have a look at it to see what is the depreciation or the useful life that they have given. So, and if you do know professionals in the similar circles, we will have to discuss and figure out whether what the useful life given is appropriate or not. So, anything that you take from any external professional, you have to take it, trust, but verify and trust. That is what I'm trying to say. It is not that we just keep that report and say that we have relied upon the chartered engineer. We just have to do a certain amount of due diligence before we accept or before we acknowledge that, okay, this seems to be appropriate in the circumstance. Right. Going back, collecting revenue, we also have trade receivables and trade payables. I have clubbed these two together because of ease of dealing with both of them. One very important thing to remember is we have classification as trade receivable and other receivables, trade payables and other payables. So it gets normally mixed up between these two. A summary list, trade payables are linked to purchases of raw materials and other items that are required for you to do the production or sale. Any other payables, security charges, auditor's fees, rent to be paid, all that will come under other payables. Similarly, other receivables and trade receivables. Trade receivables are only from the customers, and any other item that you are expected to receive for any other reason, grant receivable, for example, or something else, only that will come under other receivables. So the classification should be correct. Now that we are also giving aging analysis of trade receivables, we have to ensure that there's a provision for doubtful debts that needs to be evaluated. The moment you give aging analysis, which shows that there are outstanding for more than 1 year, 2 years, 3 years, it doesn't sound good why that should not be provided for unless there is a good reason for it for not being provided for. So provision for doubtful debts also needs to be evaluated and documented as to why there is a provision not required for a particular transaction or the balance. Foreign currency assets and liabilities not restated. AS 11 again non-complied with. Now when we talk about foreign currency assets and liabilities, it is only receivables and payables. Customer advance, vendor advances are not monetary items because they are not expected to be settled in cash. When I have given an advance or when I have received an advance, I expect that to be squared off by rendering service or selling goods or purchase of goods or purchase of service. Therefore, advances are not monetary assets and liabilities, and therefore it should not be restated. If you have restated it, then it's an incorrect accounting treatment. When it comes to foreign currency receivables, be careful wherever the dues are beyond 9 months, because the last time I read on the guidelines of RBI, you will have to inform RBI as to why there is a delay through the authorized banker, etc. Similarly, if there are long outstanding trade payables in a foreign currency, I understand that there could be a risk of RBI requirements on ECB, external commercial borrowings, that needs to be complied with. These two are some of the important areas. Again, an important one is incorrect classification between current and non-current. Now, what is given in the aging analysis is, so when we talk about aging analysis, people talk about should it be historical or is it be forward looking? Say I have raised an invoice on 1st of December, which is expected to be received, say, on 1st of May. I am preparing the financial statements as of 31st of March. Should I mention this is expected to be realized in less than 1 year or less than 6 months? Or should I put this as more than 6 months bracket or the relevant? In Schedule 3, the requirement is forward looking. When is it expected to be realized or when it is expected to be paid in case of trade payables. Therefore, in the accounting system of the company, necessary information on the credit period, both for trade payables and trade receivable is essential, because based on that credit period only you will be able to draw the aging analysis and not based on the historical information. Of course, the guidance note given by ICA also mentions that where that period is not available, then you can go from the date of transaction. But then that's an exception to the rule, not by the rule itself. So you will have to have the credit period configured in the system and then draw out the aging analysis. Similarly, you have transactions with related parties that is not getting reflected. Transactions not done at arm's length price. Under Ind AS, you will have to disclose whether the transactions were done at arm's length price, otherwise not under accounting standard 18. But then this is not being carried out in many places. MSME dues not disclosed. It applies to all types of entities. Now, for corporates, the Schedule 3 requires this disclosure, but for non-corporates where they prepare financial statements, the MSME Act itself says that where the business prepares financial statements, these disclosures, what is the principal amount due, what is the interest amount due, how much of that has been paid, how much of that remains outstanding, all the clauses relating to that disclosure also needs to be provided. And many times we have seen the interest on MSME dues are not being provided, which again is incorrect. Interest on MSME dues have to be provided for, but the technical problem is who pays MSME interest. The question of payment is later. Again, the business have to take care of it. But the accounting requirement is that has to be provided for. That is very important. From the audit documentation perspective, the auditor has to have control over the external confirmation process, including the sample selection for confirmation, sending the communication or email to customer, obtaining the confirmation, accounting of those differences, and getting satisfied as to the difference. All this also documented. Similarly, where there is a doubtful debts being provided or not provided, if it is provided, how do you say that you are satisfied with the quantum of provision for doubtful debts? If it is not provided, why do you feel it is not provided? Also needs to be documented. Aging analysis. Now, yes, the system generates the aging analysis, or there is some mechanism to generate. How has that been verified? How has that been validated? You have to take certain samples, trace it right from the invoice level, the entire line item, and see whether the dates that have been captured is correct, and then ensure that the aging analysis is complete and accurate. Similarly, wherever there are outstandings which have been classified as disputed or are not disputed, if it is disputed, you will also have to look at why there is a dispute and document it. Wherever there is a dispute and there is a legal advisor involved, then you will have to have an independent email or communication with that legal advisor, requesting him or her to spell out what could be the chances of realization, what could be the chances that they may not be able to realize, should it be accounted as a loss, should there be a provision for it. This needs to be documented. Wherever you have verified the post-balance sheet verification of these balances as to how much has been realized, many times we only keep the ledger account and get satisfied that yes, in the ledger it seems that what was outstanding as on 31st March is realized in April or May. That's not sufficient. We also have to ensure that that is reflecting in the bank statement. And the bank statement should also be documented to prove that this money has actually come in. Similarly, when there is a disclosure for MSME, then MSME disclosures, ODM certificate, interest calculation also needs to be documented. Right. Coming to employee benefits, applicability to AS 15 to non-corporate SSEs, please look into the guidance note of ICAI. Small and medium-sized companies also require AS 15 compliance. except that there are certain categories where they mention that you don't have to disclose the actuarial valuation statement, or you may not disclose certain specific items like defined benefit obligations, etc. Unless it is not very material, because generally accounting standards apply to all material items. AS 15 equally applies to all types of SSCs unless the SMCs are specifically exempted from that. We have seen balance sheets mentioning that the gratuity and compensated absences have not been provided for, or they say that it is paid on as you go basis. That's not allowed. It has to be provided for. Now, when we look at the actuarial valuation, again, like what I said for the chartered engineers case, it's not sufficient to get only the actuarial valuation report. Our work starts from the engagement of an actuary. What are the input data that the company is giving to the actuary? Say, for example, they may be giving list of employees, the date of birth, leave account balances, and what is the salary drawn. Wherever that input data can be verified, it has to be verified. Wherever there are calculations involved, like attrition rate, that has to be verified. Salary escalation rate. How do you say that 10% is the escalation rate? Do you expect management to give 10% increase in salary going forward? Look at the salary escalation rate that has been used in the actuarial valuation report last, say, 5 years. Compare that with the actual salary increase. If the salary increase is much more than 10%, then the revised rates must be
అర్థం కాల
considered for the actuarial
నేనే
valuation.
చెప్తున్నా రావట్లేదని మళ్ళీ మా ఆయన చెప్తున్నాను ఇంకా
Can the background conversation be muted, sir? Right. We also have the risk of ghost employees or non-existing employees being paid. So this entire trail of payroll, typically right from the point of how HR captures the attendance,
మేము బిర్యానీకి వెళ్ళి బిర్యానీ తినేసి వస్తాం
I
బిర్యానీ కోసం రావాలా ఏంటి?
to mute their system. It's actually disturbing the flow of the session.
మీటింగ్ ఆ ఫోన్ ఛార్జింగ్ పెడతా
So somebody can mute the audience access.
Yeah, sure, sir.
Thank you so much. So when we look at the employee benefits, we start from. Somebody is very excited.
మ్యూట్ చేసావా ఏందో
Sir, please unmute yourself, sir.
I don't know where did I stop, but I'll just start from. So right from the point of HR records, where auditors have to observe the controls surrounding the capturing the attendance, giving it to payroll, preparation of payroll, including verifying the appointment letters to see the salary that gets into the payroll is accurate, reperforming the calculations, especially of PF, PT, ESI, deductions, mathematical accuracy, checking the bank accounts, seeing any duplication of PAN numbers or bank accounts. The entire internal controls surrounding possible manipulation of the bank account, etc., should also be documented. We are now going one step ahead to also see how the payment is being made, who controls the internet access of the money transfer to the employees, who gets the OTP. All this has to be validated. Look at the board's resolution also to delegate the power of operating the bank account to a particular director, etc. and also the changes in the employee master, employee bank account, etc. Again, fraud risk is a area that we need to look at it very closely and conclude on the appropriateness of the payroll processing. When it comes to payroll processing, many of the entities outsource it to various organizations. It could be consulting firms, it could be bigger technology companies. There we will have to evaluate the internal controls of that particular service provider using SA 402, where they
Sir, you are on mute, sir.
I don't know why it gets muted all of a sudden. Right. So where did I stop? I was talking about SA 402.
Sir, yes, sir. Please carry on, sir. Just now it got muted.
Okay. So wherever there is, wherever the company outsources payroll to a particular company, it is the responsibility of the auditor now to look at the payroll internal controls of that organization. So typically we have to take the type 2 report and also look at SA 250 and impact of non-compliance with labor laws. If there are any delays in remittance of statutory dues, obviously you will have to mention that in CARO 2020. KMP remuneration is one area where we see that it is not being disclosed appropriately. What they do is they simply write director salary and give it. No, it has to be director wise what is the amount. Documentation perspective, it's not complete in many places where you do not have SA 402 report or you have not evaluated the input data given to the actuary. Then important thing is how have you reconciled the payroll versus general ledger? What are the differences and how the differences have been dealt with? So these are largely some of the areas that you will have to look at in employee benefits. Coming to other notes, related party transactions, the list of related parties is incomplete, KMPs are not included. Sometimes they write the note transactions only more than 10%, but nothing like that is mentioned anywhere. It's a practice, but avoidable because if there are transactions, you will have to disclose it. Another area that you will have to look at is provisions. Many times we see, say for example, some expenses to be provided goes into liability. Now, what are the items that can get into provision? It is all calculation based. Income tax is a calculation. It can always vary when the assessment takes place. Actuarial valuation is a provision. Warranty is a provision. Any other calculation based workings or accounts are all provisions, because provision by name itself is you do not know the exact amount, but you are just making an estimate, the best estimate that you have. But when it is a contract, when you sure that there is a liability, then you have to classify it as current liability. Audit fees, for example. There is an engagement letter. You know the fees. It is not classified as provision. It is classified as a liability. Similarly, when it comes to lease accounting, we need to look at substance over form, not mere the agreement. But then again, I'm not getting into lease because that by itself is it's a very big area of discussion. Now coming to different standards of auditing where we see non-compliances, SA 300, I'm starting because audit planning and everything is largely taken care of, including having the engagement letter and ensuring that you plan and have the right things for audit. 300, when you plan an audit, what is the audit strategy? What is the program? When you brief your team, have you documented the minutes of the meeting that the team has undergone? Fraud risk also will be covered. Have you briefed them about the fraud risk? These are certain things which gets missing in the audit documentation file. So normally, and we call this as audit strategy planning memorandum. Again, the terminologies could vary between different firms. Typically, it will actually start from what we call it as a due diligence of the client. It starts with audit strategy, the timelines, who will be getting involved in the audit, who is the engagement partner, who is the quality review partner, what are the expectations in terms of deliverables. It could be limited reviews, it could be final audits, all that needs to be documented. In the 315 series, risk assessment is missing largely in many audits because they say we have been doing this audit so long, we know what is the risk. That's not the way. You have to document on how you ensured that you have done the risk assessment of different clients. Year on year, regulations change, circumstances change. The risk perception will also change. Therefore, evidence of risk assessment is also very essential. I have put together 320, 330, 450 together because it all deals with materiality, how you have calculated the materiality at the planning stage and how have you evaluated at the final stage. Some of unadjusted errors, have you covered that in the management representation? Have you informed those charged with governance? These are some of the areas. By the way, if you look at the Center for Audit Quality Directorate website of ICAI, they have tools to calculate materiality. They have tools to generate engagement letters. They have tools to ensure that you are complied with standards of auditing at every stage in the audit. So through this forum, I welcome the members to actually go to CAQ website and make use of those tools that are available for the members for free. Right. SA 402 we have already dealt with. When it comes to SA 500, we are talking about audit evidence. Okay, you have taken an audit evidence, but how do you justify or conclude that that is sufficient and appropriate? So right from the risk assessment stage, planning, you need to map that for this particular transaction, why do you feel that these are the these are the documents that are needed to conclude or give an opinion on this particular transaction. So you need to document sufficient and appropriate audit evidence, and if you do not have it, how are you giving a conclusion? 501 audit evidence I have already covered with in inventory valuation. I have also covered external confirmations. One important standard is SA 510, initial audit engagements. Typically, when you're doing audit for the first time, it's not sufficient only to check the transactions and the closing balance and say, anyway, the opening balance is done by the other auditor. No, you have to review the opening balance. You have to recheck the grouping, schedules, get satisfied on the opening balances also. For example, if you feel that you need to get confirmation for opening balance, please go ahead and do. If you need to get certain confirmation for the stock, then you have stock statements, you have to do roll forward or roll backward procedures and ensure that you get comfort over the opening balances also. And when you write on the opening balance, we also have to, as a first-time auditor for that particular client, you have to use other matter paragraph and mention that the previous year numbers have been audited by another auditor whose report dated so and so was given, and it is an unmodified opinion. But if it's a modified opinion, how have you dealt with them this year is also important. I have also covered a little bit on sampling. Methodology also has to be documented. Then we have SA 550 and related parties. So normally we review the board minutes, we take a confirmation from company secretary as to these are the list of related parties, and be very careful in related parties, because what is related party in US 18, India is 24, the company law, the income tax, the SEBI regulations, they all could be different. So you will have to have a harmony of all these regulations to see who is a related party for which provision, and then arrive at the conclusion. Going concern is another area, especially companies that are making loss or they're having working capital issues. Very important to see how they're going to evaluate the going concern. And there are about 16 to 17 parameters that SA 570 has given, both operational, strategic, financial, and we'll have to go through each one of them and document with evidences as to why we feel that the company's going concern assumption is adequate. Written representations have to be taken. Sometimes it comes after the audit. No, it has to come before the audit report gets signed. Typically, we request our clients to, give it along with the signed financials. It should be taken on board because the board also has to take onus of the representation. When we are using the work of another auditor, group audit communication has to be sent. We will have to discuss those group audit requirements with other auditors and how we have drawn the conclusion. Again, under other matter paragraphs, today in SA 600, we are mentioning that we have relied upon. But as you may have read in the news reports, NAFRA is coming out with ISA 600 equivalent, which is going to completely turn around the way the group audit is being done. Again, I leave it to Vijayawada SIRC to have a program even on that ISA 600 or the proposed standard, because that completely changes the way the audit of group companies or the group is being done, and it will definitely impact whether or not you are the auditor of a parent company or a subsidiary company. When it comes to using the work of internal auditors, it's not sufficient just to have the internal audit report. We have to start from what is the scope of the internal auditor, how have we ensured that they are independent, especially in those companies where they have their own internal audit team, whom do they report to. Compliance with standards of internal auditing is also essential. How have you ensured that the internal auditor has covered all the areas, may not be in this year, but at least in phases, the critical areas? And how have you ensured the review of the internal audit report and its impact on the financial statements? Yes, you are welcome to even have discussion with the internal auditors and minute the discussions of the meeting. If you are using the work of your own expert, suppose you have a CISA or a DISA professional in your firm, that's using the work of an auditor's expert. Typically, when you have to report, say, on audit trail or backup or IT related items, you have to take the expertise of, an expert and look at their work as well. Now, coming to the other very important areas is on audit report. Now, when we look at the audit report, sometimes we mention profit and loss account. It is not so, it is statement of profit and loss. Under AS3, it is cash flow statement, and under Ind AS 7, it is statement of cash flows. In the audit report, don't mention anything about para 7 or para 4 or company accounting rules 2014, etc. That's gone. We now only have to refer to company accounting standard rules 2021 or company's Indian accounting standard rules 2015. Sir, can that be noted, sir?
దాన్ని బట్టి మగపిల్లడు ఆడపిల్లడు డిసైడ్ అయితే ఇమెయిల్ కాదు మెయిల్ ప్రకారం జరిగింది. Doing that, sir, doing that.
No problem. Right. So another important thing in the audit report is obtaining an understanding of internal control to the audit in order to design audit procedures and appropriate. That is a standard statement that we gain auditor's responsibility. But when you are not giving a report on IFC, because IFC doesn't apply to that company, then you should also add what are given in the red color, but not for the purposes of expressing an opinion on the adequacy and effectiveness of internal financial controls. If you do not report that, then it becomes an incorrect audit report. That means I should be reporting on the internal controls. Then the terminology of internal financial controls with reference to financial statements has undergone a change that has to be taken care of. Many times I've seen UDIN numbers being written on financial statements. Not correct. UDIN is only for audit report because it is the auditor's number. It is generated by the auditor. It is not for the company. You can only write the name of the firm, firm's registration number, the name of the proprietor or the partner, partner's membership number, place, date, and signature. UDIN number will only be in the audit report, not in the financial statements. Then, where the director signed the financial statements, we also have to ensure that we have an extract of the board authorizing the respective directors to sign the financial statement. That is also essential. Wherever you are qualifying something in IFC, keep in mind how does it impact the main audit report and act accordingly. And in 143.3, where we are reporting that, reporting of managerial remuneration is not applicable, or reporting of disqualification of director is not applicable, say in case of a government company, we also have to give the reasons why it is not applicable, not merely mention that it is not applicable. When it comes to emphasis of matter paragraph, many times we have seen instead of writing qualification, it comes in emphasis of matter. Emphasis of matter is not a substitute for qualification. One, it is not a replacement. If something has to be qualified, it should be in the qualified audit report. Emphasis of matter cannot be used or to correct or justify what is given in the financial statements. You don't have to explain. You don't have to give any reasons for it. Just like how we are reading a book and we find something important, we just highlight it, just for the sake of reference. Similarly, emphasis of matter acts as a highlighter. You just have to mention note, refer, note number so and so with regard to full stop. Our opinion is not modified in the above matter or in this matter. Conclusions are not drawn in emphasis of matter. We are only referring it to a particular fact what is mentioned in the financial statements. If something is not mentioned in the financial statement, it cannot be an emphasis of matter. Suppose if something is to be there in financial statements, very critical, and it is not mentioned, then you have to go for qualification and not for emphasis of matter. Emphasis of matter will only say, yes, this is the financial statement. This particular point or note is important for the shareholder to understand. It plays the role of a highlighter. That's it. Then, material uncertainty on going concern itself is a separate paragraph. You cannot bring the contents of going concern in UOM paragraph. So, this is also very important, and where you place the emphasis of matter is also important. The other paragraph that is very important is other matter paragraph. Again, there also we need to mention our opinion is not modified in this matter. It typically covers the circumstances in which the auditor or auditor's responsibilities are. Like as I said, the previous year numbers are audited by another auditor. I place reliance on that, so I'm writing that in other matters. Or I'm relying on the subsidiary auditors, so I'm writing that in other matters. Or I've taken an expert advice, typically in case of a companies which are highly technical, like oil and gas industry, or in a life insurance industry, where it is beyond our understanding on technical matters, then we go for other matters and say that we have relied upon them. Otherwise, other matter paragraphs cannot be used for anything relating to financial statements. Anything relating to financial statements will either come as a qualification, modification, adverse or disclaimer, whatever that is, or emphasis of matter. Other information is also very important. When we talk about other information, we expect it to be the contents in annual report, including the director's report, management discussion analysis, risk management report, BRSR, etc. To what extent your client is equipped to give this information before you sign the audit report is also very important. If the information is not available before signing the audit report, then the auditor should mention that on the date of signing the report, other information is not available. Whenever it is made available, they will read it and take appropriate action. But where the information is available, then the auditor is required to comply with SA 720 and see there is consistency between other information and the signed accounts, or which is expected to be signed, and then report to those charged with governance if there are any inconsistencies. The common mistakes that we see is the secretarial audit report comes out with non-compliances, but the auditor has not considered it. Or the director's report will contain about future expansion plans, but nothing is mentioned in capital commitments. Directors talk about interim dividend or final dividend, but audit report doesn't mention anything on compliance with 123. So typically, we will have to look at the various aspects in other information or annual reports and then conclude. As I said, all the contents of annual report may not be available. You may have the critical documents and that needs to be reviewed. Now, the most important you will see in many of the accounts this time is on the backup of accounts and audit trail. Wherever we are mentioning an issue in audit trail, it has to be mentioned in three places. One, under 143(3)(b), whether in his opinion proper books of accounts as required by the law have been kept by the company. Because this relates to books of accounts, you will have to mention it in under 143(3)(b). Then under 143(3)(h), you will have to mention any qualification, reservation or adverse remark relating to the maintenance of accounts and other matters. Then again under 143(3)(j), you have to mention on Rule 11G, whatever is the paragraph. The same thing appears 3 times, no other option, but that is how it has to be reported. Once you report this, also look at what are you reporting in IFC, what are you mentioning in CARO on the maintenance of PP register and inventory records, what are the remarks given by the internal auditor, does it all sync well, is something to be seen. When we look at the backup, what is the proof that the company has a backup not only for 23-24 but for the last 8 years? How do you know that the server is physically located in India? How do you know that the backup has been taken for all the days during the year? These audit evidences are absolutely essential before we give the audit report saying that yes, there is an audit backup. Similarly, when there is an audit trail, do we have the entire list of edit log? Do we have log of changes both at the application level and the database level? Do we have approvals for the log of changes and the reasons for the changes? What are the system level controls? I understand that for smaller and medium organizations, this could be a little bit demanding, but the law is law, and the law doesn't differentiate in this particular aspect between a small company and a large company. Everyone has to maintain the same set of system requirements. So whatever are the conclusions that the auditor is drawing up on books of accounts and audit trail also has to be documented adequately. Now, most of these systems typically should be able to generate a log. You have to ensure that you also take a screenshot or the process of generating that log, from which date to which date it is being generated. How do you ensure that the report that the client gives you is not tampered with, right? Is it in an uneditable format? Or would you want to sit with the client and take the report? We leave it to the judgment of the auditor. But these questions can come up. Suppose if my client gives it in Excel format, as a reviewer, peer reviewer, I can ask as to how do you ensure that the Excel file that is given to you is not tampered with? So again, we are looking at fraud risk also in this point of view. Anything that you do, think from the reviewer point of view as to what could be the questions that can come up, and ensure that you have an audit procedure today laid down to ensure that those questions are answered. When it comes to documentation, extremely important. We are today talking about firms quality control, manual, monitoring document, absent in many audit firms. Appointment of quality review partner or professional is not appointed, and they have not reviewed the financials before signing off. Even when you have a discussion with your quality review partner, that has to be documented. Then lack of audit planning documentation, which I've covered, engagement letter, communication with the previous auditor, communication with those charged with governance, all this have to be recorded. And when it comes to peer review, the ICI is now moving towards ensuring um, most or all of practice units are also covered under peer review. What information I have taken from the ICA website is given here with, but you can always get an update from the ICA website as well. So if you see, depending on the size of the firm, depending on the nature of practice that they have, the peer review becomes applicable. Then the rigor in which the documentation should undergo will also have to be enhanced. And we have different reviews. Reviews can be done by FRRB, Quality Review Board, NEFRA, regulators like SEBI, IRDA, RBI, PFRDA. There are many regulators today who can look into the requirements of the audit documentation. And I will just touch upon some of the other developments, slightly digressing from the topic, because this is essential for all the members also to know. Advent of audit quality maturity model. ICA has already released version 2 of it. We will have to have an AQMM score ready, because these days the clients want to hire those firms whose AQMM is at least 3, if not 4. If it is 1 to 2, then you have a long way to even to catch up. So AQMM, there's typically a list of close to 200, 240 plus questions on the practice areas, the administration, the HR, the technology related, the quality review mechanisms, etc. of the firm. You need to answer those questions. For every question, there is a marks, there is negative marking also. Then you end up with a score. Depending on the score, you are ranked 1, 2, 3, 4. 1 is the lowest, 4 is the highest. If you have to move from rank 1 to 2, 2 to 3, 3 to 4, there has to be a roadmap for that. Most important, this AQMM will also be subjected to review by the ICI, and if they say, sorry, what you rank you have given is incorrect, you have to go back to the drawing room and start working on your the entire firm's strategy on improvising the AQMM. Then we also have something called as digital maturity model that has come up. So this will all require good amount of documentation and process reviews that are very, very important. Similarly, the existing set of accounting standards 1 to 29 will be diluted or will be removed over a period of time, and there are new set of accounting standards which are going to be released, which is more or less aligned to India's. That is another development. Use of AI and ML in audit, it has become a need of the hour because of skill sets, because of the volume of transaction, reduced timelines, increased complexity, increased documentation. It is just a matter of time where, whether the firm is small or big or medium sized, you have to adopt in some way or the other AI in your audit, otherwise we will be left out in the race. ISA 600 is one widely discussed. Are we moving to international standards of auditing that comes with more rigor, more practice? We are culturally different. Our economy is different. So there are a lot of other issues that's why NFRA has come up with a consultation paper which is available on their website, and the members would have to look at it. Again, ICA is also looking at it very seriously. Then we have the impact of sustainability related developments that are happening, which has impacted the financial statements, especially the climate change accounting, disclosures, governance related aspects. Baseline assessment is becoming very essential even for smaller and medium sized enterprises, especially those who have exports and those who have transactions across India or including the European Union especially. Whether or not you are a listed company, you are expected to meet certain minimum requirements of ESG. That's again becoming another area. One more area is IFRS 18, which has it should revamp the entire set of financial statements. So whatever statement of profit and loss we are looking at it is going to be done away with, and they are going to bring out a new format of statement of profit and loss depending on the operating activities, investment activities, and financial activities. But that should not be mistaken with AS3. These three activities, their name looks similar, but they're completely different. So there are three many changes that are happening in the financial statements and audit domain. And as members, it's our responsibility to ensure that we are all updated and take the opportunity. So my conclusion here would be look at various guidance given by ICI on the accounting errors and the auditing issues. Ensure your audit documentation is complete. Constant updation webinars like this will be really helpful. Use technology, use ICI checklist and other tools. There's a lot of literature available that needs to be read, understood. I know time is a constraint, resources could be a constraint, understanding the client and the client understanding our requirements is a challenge. But then that's the world that we are in now, where we have to be constantly up against all this and ensure we meet the requirements of the standard. So thank you so much, and thank you for investing your time. Happy to take any questions that any of the audience have it. Any questions, sir? Jayan, sir, secretary? Or is it like it was all over the board?
So anyone want to have any questions, or you also can type on the chat box. If you don't want to talk, you can just type the query in the chat box.
Somebody has asked about presentation. It's already available with the branch, and they should be able to circulate
We'll
it.
be posting in the WhatsApp group, sir. Once the
Thank
session
you.
is completed, we'll be posting that in our Vijayawada WhatsApp group.
So there are a lot of things happening in the financial statements domain and the audit report domain, and the way people are looking at the audit report, the way people are looking at the financial statements by itself is undergoing a change. If you look at, if you want to see how the audit reports will look like in next 2 years, I always say look at the west, and then naturally it will come to the east. So if you look at some of the reports in west, they are also looking at disclosing what is the materiality levels in the audit report. So that is the kind of disclosures they are looking at. So audit reports are also becoming bulkier and bulkier, and too many editions. That's what regulators expect us to deliver. We have to deliver.
Any other questions from the participants? I hope no questions, sir.
Well, was it overboard? Bounces.
Anyway, thanks for your detailed presentation, sir. Definitely, this will be helping us in our routine schedule. Anyway, thanks again. Thank you once again for joining our branch, sir. We expect you future also in the same collaboration with you.
Happy to be there, sir.
Yeah. This time we hope you will combine a physical presence, sir, rather than
Sure.
virtual. Bangalore is any 1.5 hour away from Vijayawada. We'll try to invite you to the next any conference.
Technically, I'm in Bombay now.
Oh.
So I keep moving. So wherever I am, I'm happy to come over as long as the schedule is convenient to both of us. Definitely, I look forward to come over, and we can have a good interaction.
Yeah, sure, sir. Sure. Thank you again.
Thank you.
All the participants as well. So we'll meet in some other next session. Thank you. Thank you.
Thank you, sir. Thank you.